Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, London UK feed wheat, and European processing potatoes. Now, I'll start with Paris milling wheat. The question I asked here some 4 weeks ago has still not been fully answered. I asked, and I quote, "Is this action since the May high a bearish halfway hesitation or a lopsided, it looks better if you discount the May spike down anyway, double bottom?" End of quote. It is obvious that there is no longer the chance of a bearish halfway hesitation. However, neither does the double bottom look that good as well. The one pattern that we do still have in operation here is the chance of a monthly key reversal up for July. If we close on Friday either over 213 even or 213 even, let me get that right, 213 even, or under 209.5, then we'd be on. Closing within that slim band between would give us a lesser outside month. Right now it looks like the market is sitting on some good support, but looks can be deceiving. You see, though we didn't make a weekly key reversal up last week, nevertheless came very close to doing so, and in that move up, the now supports, well, they were sliced through like hot knife through butter. Anyway, below we have the recent 50% Fibonacci line at 212.75, the gently rising long moving average currently 212 even, the falling medium moving average currently 209.5, the 50% Fibonacci line of the August 2020 to January 2021 move at 206.25, and then two strapping 50% Fibonacci lines that held the market up 2 weeks ago. Those ones are still good and caused the rise back up last week. They are the December 2019 to January 2021 move at 200.75 and the big old 2009 to 2012 move at 200 even. Meanwhile above, well, there's only one real level to look at, and that's the 220 area, which has been this week's high and back at the start of June also. London UK feed wheat. When last I spoke on ICE feed wheat, the market was about to tip over into a second possible bearish halfway hesitation, which it duly did in early July. Interestingly, the market's decline halted at the broken lower time, currently 171.05, of the bearish shift pitchfork of the May to June move. Now, I've kept it on the daily chart mainly because it was so accurate, even when it was no longer useful, or so it seemed. The halt to the fall in July put down more actually to three other factors. The congestion from March to June 2019 between 161.95 and 165.75, the congestion at 162.70, 162 even and 161, and probably above all to the big old 50% Fibonacci line of the 2012-2016 move at 164 even. Since then prices have pulled back up, but started stalling once they came up to the June low at 179.35 and have started to move back down again. Interestingly, the 50% Fibonacci line in the September 2019 to May 2021 move at 172.10 did nothing on the way down. However, I'll put that down to changeover, and it may have an influence this time as and if prices get closer. Now looking ahead. Part of me wishes to look at the action since June as a possible expanding descending wedge pattern. However, another part is not keen on that idea, other than a way to show the market channeling lower. Maybe that is really what I'm seeing, a large, bearish, imperfect channel, currently 171.05 to 179.70. We'll have to see if that works out. Meanwhile, further below we have some more congestion peaking up between 136 even and 147.75 from 2016 to 2018. Whilst overhead we have the 50% Fibonacci lines at 188 even and 189.5. European processing potatoes. One of the features of using continuation charts on futures, as I do, is that you occasionally get huge gaps after changeovers. This market is an example of just that. The market was going sideways in the 13.8 area, then suddenly a huge gap up. Not I'm complaining of the direction. As you recall, I highlighted a bullish bow tie at the beginning of May, which would indicate a possible move higher some 15 to 20 trading sessions after the, let's be honest, imperfect crossover of the moving averages, which were also in the wrong order on the crossover for such a move. The kick-in was due between the 24th of May and the 1st of June, and dutifully we had such a move up, if only because of changeover. What is interesting about the latest move up is that despite some large gaps, the bullish Andrews pitchfork for the November 2020 to March 2021 action is still valid. All that has happened is that the market moved up from the middle time, currently 16.7, tested the upper time, currently 21.4, failed, and went back down to the middle time support at the start of July. Since then, prices have moved back up, but they seem to lack the energy to really push higher to the upper time again. You see, they were okay navigating through the 50% absolute Fibonacci line at 17.5, but they have gotten caught last week and this at the Fibonacci congestion at 18.5. It's actually somewhat surprising if you ask me, but understandable. Lately, this week, they have started to come back off, but have been very surreptitious about testing the 50% absolute Fibonacci line again from the top side. Perhaps they can now sense what is going on there. Anyway, I'm still amazed at the brilliant performance of November 2020 to March 2021 bullish Andrews pitchfork, especially the middle and upper times. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Service International Limited. And here comes the final bit.